the S&P has given back, let's say, half of its gains from its highs, right, earlier this month or so. But it seems to be kind of hanging in there, man. Like, talk to me a little bit about that. That's my chart. You see the uptrend, you see the 150-day. Just so you know, people, today, every moving average in yellow is 150-day. That is in honor of CBW. Thank you.
There we go. All the honor to you too. Thank you for that. Look, it's in many ways as nuanced a moment as any, which is to say, if something is just in a steady, orderly uptrend, we know what to do, or at least in principle what to do. Stick with it. If something's just down to the right and heading out of business like Enron or WorldCom, we know what to do. Either stay short or certainly don't be involved in the long side. It's when you're in a moment of equilibrium, when buyers and sellers are matched off, when capital coming into the market, embracing new securities is matched off with money that's exiting. It's tough to figure it out. And that's what really a pair of twos is, right? Meaning it's not a hold. Hold is a Wall Street euphemism for sell. Yep. What it is it's just not a particularly good hand. We bet big when the hand is big, a full house, a three of a kind, a straight, but a pair of twos, it's not even a pair of eights or a pair of tens. It's basically, you're getting down to almost 5 random cards. And so that's what we've got here. I've got some charts of the S&P, but we might have, here's one of them, but let's start in the beginning. There are no lines, no judgments, no annotations. Now, one way to draw the lines is, of course, seen here. So yes, we did get above that thing, but a lot of this is just the same way a fundamental analyst will say, well, we're changing our price target from 70 to 74 because we think the gross margins are better, the buyback will be bigger, or what have you. You can always change your lines. The lines are meant to be an aid to try to figure out, look at those arrows. So does that mean just because we've overshot and now checked back that we have to bounce? Well, I would say you do it the next way. You just alter the lines, and then all of a sudden, look at this next iteration. We're just back in the malaise. Forget the fact that it was strong in sort of late January, early February. What we know, and this part is incontestable, when we were at the August peak, Wall Street came out in its infinite wisdom and said, there's a new bull. We've retraced 50% of the decline. And not only was that not the case, it was the single worst time you could have committed capital in the past 6 months. We went straight down and made new lows in October. What happened in the last days of January? In the first days of February, when we hit that high, almost 4,200, it's a new bull. We're up 20%, says the Wall Street Journal, and major analysts, and all it's done is gone straight down since. Now, does it mean it has to collapse here? Not really. It's kind of a bad hand. It's a pair of twos. When you've got a bad hand, in Texas Hold'em, 75% of smart players fold when they've got a marginal hand to play.
Well, listen, before we get to some longer term charts in the S&P 500 that you want to take us through here a little bit, you had a great note on worthcharting.com. Check it out, people, on just your kind of a pretty good explanation, going a bit deeper than you just did on what a pair of twos are. And you have plenty of examples of that. So check that out, people. Talk to us a little bit about, okay, so we're banging up against that uptrend. We saw that even in my rudimentary chart there. Let's back it out a little bit. Let's get back to the financial crisis here. And let me ask you this, Carter. For a lot of people who are watching this right now, what do you place more emphasis on, right? Because we're obviously at a level, you just gave us the Fold'em sort of thing at that uptrend here, but now you're going to show us, a chart going back, almost 15 years or so. And is there different periods where you place greater emphasis on short duration charts versus longer duration charts? I'm just curious how you think about that.
Right, there isn't. So I'm looking at all time frames as much as I can in all iterations, meaning this is a log chart versus arithmetic chart. It's weekly bars versus daily. And so what pattern interpretation is, it's current price juxtaposed against past price. And that is how you're trying to figure out future price. So if we have a second, let me put this in the fundamentals parlance. If you and I were sitting in a conference room, I've had this many times, right? And someone burst into the room and said, Dan, Carter, stock XYZ just reported 14 cents for the quarter. In and of itself, that data point means nothing. It's that data point, that 14 cents earnings for the quarter, juxtaposed against past data. So what if we then learned that all the other quarters for the past 10 quarters were 50 cents, 80 cents, $1, and it came in at 14? We're like, whoa, this is terrible. Versus someone burst in the room, stock XYZ just reported 14 cents. We're like, In and of itself, that data means nothing. But if we look back and said all the other quarters were losses, and it just put it to its first profit of 14, meaning the 14 cents in quarterly results is only relevant in the context of preceding results. And so current price juxtaposed against past price in all time frames is how we figure out future price. So with that, look at this chart. It has no drawings. Let's put in some lines. And what you've got here, and this is incontestable because I didn't manipulate them, they're mathematically parallel lines. If you take the 09 low, financial crisis low, with the COVID low, and you simply then add a second and a third line, you have a perfect channel. We went out through the top of that channel, and at that point in 2021, the valuation was as high as the dot-com peak. And of course, we've given it back half. We're sitting at the midpoint, literally at the midpoint. Put another iteration in, and look what we've got. Very clear. Financial crisis, low. The peak, of course, 11 October 2007. We dropped basically 50%. And there are your lines. So you can see, obviously, if you're bullish, just to get top of the channel, which I think is no chance of that this year in 2023, we would barely make a new high, which is to say the Jan 4, 2022 highs are going to be very hard to exceed, even if you're bullish. And then, of course, do we have to get down to the lower band? We're not even in the lower band yet. We've only been in the lower band twice, the 09 low and the COVID low. I think we continue to work lower into the lower half. And ultimately, there is the very distinct possibility that we yet again touch down at the lower band as we did on the lows of 09 and the COVID low.
I'll tell you one thing, man. I mean, that is a pretty fascinating chart. And again, it was a great explanation of just kind of using the shorter dated information, the charts, and juxtaposing against the longer dated one. And when we spend all this time talking about the October lows at 3550 or whatever, and then the pre-pandemic highs at 3400, the S&P 500, you look at that log chart going back 15 years, and you look at the level that we are at, it would just not be that hard for us to come by those sorts of levels. So I appreciate that.